Hey guys, it's Eric Green. Listen, how do I make sure that all these potential clients sign my letter and pay me before we start doing work? I use Anchor. Anchor created a fully autonomous billing system and closes the cycle with zero errors. It sends our agreement to the potential client. We'll follow up with them automatically to make sure that agreement is signed. It alerts us when it gets read, when it's signed, and when payment is made. And this way, you know where you are every step of the way. I was so impressed with Anchor, which, by the way, is free. We went to Anchor and have partnered with them. Now, if you go and you register with Anchor, which is free, by the way, if I didn't mention that, you will get access to all of our checklists and letters, okay? But you have to go through our link, all right? Again, by the way, Anchor's free. There is a $5 fee per transaction if you're wondering how they make money. But given that our minimum retainer is $750, it's less than 1%. It's nothing, okay? So again, it's free. They charge the $5, transaction fee on payments, and it will automate your onboarding clients, make follow-up, just puts it on autopilot. It just saves you all that stress and you will close more deals. All right. So sign up here. It's www.sayanchor.com/tax rep. Again, sayanchor.com, sayanchor.com/tax rep, TAXREP. When you go through there, you'll sign up for free and you will have access to all of our letters and checklists, which will save you the trouble of recreating them yourself. All right. Go check out Anchor and put that closing process on autopilot. Guys, I've told my horror story before with S Corp clients and how do you know what reasonable comp is? My horror story is when they went after that CPA who was a friend of mine for $125,000, arguing that he knew and that he knew better and that he should have made sure his clients took reasonable comp. I'm a huge fan of RC reports. RC reports, it's about $1,400 a year. We're charging the S Corps that come to us under audit $750 a piece. We'll probably make between $10,000 and $20,000 with RC reports. But if you have S Corp or C Corp clients, they have to each year get a report, and the report is as simple as possible. RC Reports has a huge database of businesses. It will give you a report that you can rely on. And so far, to date, when we produce that report, not a single auditor has challenged it. The critical thing right now is for your clients to get that report to support the number they're taking on the return, that you're taking on that return that you're signing. Best way to do it, RC Reports. Go check it out, okay? You can find them. It's trn.rcreports.com. Again, trn.rcreports.com. Go there, you'll save $100. It will change your practice, create an annuity stream for you, and bulletproof your clients' corporate returns. The Tax Rep podcast is now proudly partnered with Nice Job, the experts in reputation marketing. Reviews are so important for attracting new clients. Before Nice Job, I would ask people to leave reviews, but they would usually forget, and I didn't have a way to stay on top and remember to follow up with them. That's where Nice Job comes in. Their smart follow-up campaign recognizes who hasn't left a review yet and automatically sends carefully timed reminders that can increase your chances of getting a review by 300%. I tried Nice Job for Tax Rep, and it's been a game changer. We added 33 five-star reviews in our first month, and our Google business profile is like a magnet for new customers. You can try Nice Job for free for 14 days and get 50% off your first 3 months by visiting nicejob.grsm.io/taxrep. nicejob.grsm.io/taxrep. I'm going to put a link in the description of the podcast. Try it. It will be a game changer for your business as well. How do I manage my tax rep practice? How do I get transcripts? How do I track what is going on with the IRS with every single one of my client cases? How do we complete the offer forms, the powers of attorney, everything? We use Tax Help software. Tax Help software is the cornerstone of our practice. We use it for its intelligent ordering. Every single night, it will update the transcripts on our clients, so we will see things happen long before those letters even go to the mail. We can then, react. We can let the client know. We can get all the transcripts we need to determine what our client's best options are, when is the debt going to expire, and we can fill in all of the IRS forms and get them filed accurately, the analysis done correctly. If you're interested in giving it a test, go to taxhelpsoftware.com, use promo code TaxRepTrial, all one word, all caps. You will get a free 2-week trial. Again, that's taxhelpsoftware.com, TaxRepTrial, all caps, for a free 2-week trial. If you love it and want to buy it, use TaxRep10, capital, all caps, TAXREP10, TaxRep10, all caps, one word. You'll save 10% on your purchase. It will be the engine that runs your tax rep practice, just like it's what we use for ours.
Good morning or good afternoon to our listeners. This is Mike Villa, serving as a guest host for the Tax Representation Network and sitting in for Eric Green as a moderator today. We've got 2 guests that I think our listeners will enjoy listening to. We're going to be discussing virtual currency, reporting and enforcement developments from the trenches. And I've got 2 guests that frankly make me feel pretty inadequate. For the listeners that don't know me, I am a tax lawyer in Dallas that focuses on white-collar criminal defense and tax litigation. But my 2 guests are highly accomplished tax professionals. First, we have Stacey Ferris, who is going to tell us a little bit about her top secret clearance that she gathered in her background. And then we also have Damon Rowe, who also has top secret clearance from the Department of Defense. So I'm the only speaker today that does not have top secret clearance, and therefore I feel a little inadequate today. Stacey is a CPA and certified fraud examiner with HKA, a multidisciplinary consulting firm, and has a bachelor's degree in accounting and a master's in forensic accounting. How does that background get you to a minor in Chinese? How did that happen?
That's a long story, but always had a passion for languages. Accounting was more the accident of ending up in a business course and going, oh, this isn't that complicated. But my original plan for life was to be a diplomat. So I wanted to work in China, work in Asia, and I moved to DC because I wanted to join Department of State. But here I am, still accounting. So
I don't know, Stacey, with that top secret clearance and a Chinese background, I think you might be hiding something from us. But she's assured me she does not work for the CIA, but I don't know.
It's a need to know basis. Sorry, Mike.
Need to know. That's it. So now Stacey also has done some interesting work on our topic today on virtual currency within as a professor at the University of Maryland. I understand that you have developed a blockchain and crypto course. So what does it take to develop a course on blockchain and cryptocurrency? What have you done in that arena?
Well, I started getting into the space around 6 years ago, just as a personal investor and all that, and learning about it. I was attending every conference, every webinar, everything I could find. And that really came out of a project that happened in 2017. My CPA firm at the time won a contract with NIST, National Institute of Standards and Technology, to do an economic impact study of the advanced encryption standard. And that led me down the wormhole of studying encryption and reading about it. And that's how I kind of got into this blockchain stuff and understanding it. Met a lot of people who were developing and fiddling, as they call it, in the space. And I ultimately ended up working with a startup as their product manager for some audit products. And it's been a long and winding road. And ultimately what happened is University of Maryland, I know some of the professors there, and they approached me and said, hey, we want our accounting students to understand what this crypto stuff is. Would you be open to developing a course? And so I said, yeah, I'll take the challenge. And I took it, and it's been a lot of fun, man. I'll tell you what, you have to know something inside and out to teach it well.
I think that's right. You do have to know it inside and out. And I think the other thing with virtual currency is you mentioned one word in there that was it biddling, I think I heard maybe. What was
Yeah, biddling, yeah, hodling, biddling.
It just reminded me, and I hope the listeners at home understand that within the virtual currency world, it has its own dictionary, right? It's got its own words. It has its own, they have their own meanings, right? And these are not words that we use in the regular world. This is in the virtual currency world. So if an accountant or a tax professional is wanting to get involved in the virtual currency world, is it important for them to understand all the vocabulary that's out there before diving into the virtual currency reporting world?
I think you can probably learn as you go. I don't think it's overly difficult. I don't think it's really a barrier to entry. Learning the vocabulary is just something that happens as you move along and you get more into the space.
So they don't need to buy your textbook to go prepare a tax return on virtual
There
currency.
is not a textbook. There is no textbook.
It's a virtual textbook, right?
I teach the course entirely from free materials online, from NIST and from other research documents. There is not a textbook. And that was definitely one of the big challenges of teaching this stuff. No textbook.
So you're kind of like the Chat GPT. You're scraping other people's data to pull it together for your own course book. It's all in your brain. That's right. All right. Well, thank you. Well, we also have Damon Rowe with us. Damon is my law partner here at Meadows Collier in Dallas, Texas. Damon has an LLM in tax law and also a bachelor's in accounting. But Damon worked for over 20 years with the IRS and the IRS Criminal Investigation Division. He didn't just work with the criminal division. He was the special agent in charge. And for those of the listeners who don't know what that means, within the criminal division, Damon was the head cop for the criminal division in Dallas and then in Los Angeles. So he was the guy with a gun and a badge trying to put the tax cheats in jail. And then from there, he worked his way up to a couple of national roles where he was the executive director of international operations and for CI and the executive director of the Office of Fraud Enforcement for the IRS. And I believe in those roles that you also have some virtual currency training from the IRS. And apparently you also have top secret clearance that, once again, I don't have. So tell us a little bit about, with your roles at the IRS and how maybe some of that virtual currency training came to be and how you implemented it in your job there with the service.
Certainly, kind of going backwards, the last spot, Office of Fraud Enforcement, when I was the executive director there, we really wanted to roll out some training for the IRS. You talked about the biddling and the words that people use in the cryptocurrency world. We wanted our auditors who were actually auditing the tax American public to be fluent in this area. And without fluency, they couldn't understand the taxpayers' problems or taxpayers' needs. And so our whole issue was to try and, at that time, was to get people to the right answer. If our auditors were confused about what was happening, they might have been defaulting into some other thing that wasn't the right answer. So it was important to have that fluency. So we didn't have a book either, but we did develop some training through some outside third-party sources, and we were able to do that. And I think they've come a long way in the last 6 years.
So it's pretty interesting that in order to get the source material for all this training, it sounds like a lot of us are having to go to third-party sources to try to educate ourselves in this evolving world. I think that's kind of an interesting side note, because where we're at in this, I think, timeline on virtual currency and tax reporting and enforcement is that we're in a place that is now requiring us to teach ourselves about a new area, and yet it has real-world substantive impact and consequences. So one of the things we wanted to talk about here today with the listeners is, within the virtual currency world, what are some of these substantive areas? So, for example, Stacey has provided me with a chart that she's put together, I think, with a group that she's working with on digital assets. And it's like a hierarchy and a flow chart of different types of digital assets. I would submit to the listeners, it's a very easy to read chart. If anybody wants a copy of it, you can reach out to us and we'll happily send you a copy of Stacey's chart on digital assets. But Stacey, if you can maybe walk us through, what are some of these basic types of digital assets that the listeners might want to be thinking about if they're first getting into the world of having to deal with tax reporting or information reporting related to these digital assets?
So digital assets for the IRS and taxes, they're all treated as property, regardless of whatever type you have on that hierarchy. The hierarchy is also going to be published in the Journal of Accountancy in the next few months, so it'll be available publicly soon, along with an article that will walk through each of the different categories on that chart. There's three main groups on that hierarchy, and this all came out of me trying to teach it. And when you're doing accounting, you have to identify what am I dealing with first, right? And because although for taxation you treat it as property, but that doesn't really work very well in GAAP and accrual accounting. And so I realized I needed some way to break down, like, here's the landscape of the assets. So you got three big categories: CBDCs, fungible crypto assets, and non-fungible tokens. Most of what you're talking about with taxation is going to fall into fungible crypto assets, and then within that group, private issuer tokens and the fully decentralized box, where right now I only put Bitcoin into the fully decentralized category. Virtually everything else falls into private issuer. The stuff that you think about is like coins and money. It's not money, not real money, right? And it comes into private issuer, and it's going to be, by and large, a lot of them are some kind of utility token or stable coin. Those are your two huge categories of tokens that exist out there, and they're popular for trade. The purpose of that hierarchy is that, like, if you know what you're dealing with, it's a lot easier then to figure out how you treat it. And for tax purposes, maybe it's a little simpler because everything's property. You apply like the capital gain and loss type rules, and it can be pretty straightforward. But when you get into accrual accounting, you have, based on the type of asset, you're going to account for it differently, and it can get quite confusing. You're not going to treat Bitcoin the same way you would treat NFTs. If you're into DeFi and you're doing a bunch of DeFi activities, you're going to have different types of assets that might require specialized derivative accounting. So I was looking for a way to give the accounting community a standardized way of talking about the assets so that we could actually really have conversations about how do we treat this stuff and be speaking the same language about the types of assets.
I kind of wondered, I don't know that there's an answer to this, but as you move forward as a tax professional, I mean, one of the things we're talking about here is how to help regular people who have invested in Bitcoin or NFTs, and maybe they're trading in these types of virtual currencies or digital assets on a regular basis. How do we help them properly report it for tax purposes and then just for information reporting purposes as well? And you're generally going to be dealing with a lot of individuals. If they're in this space, they're probably fast-moving, technology-loving type of people. And so how do we get with those types of taxpayers in advance of them being fast-paced and moving things around a lot? How do we help them keep that organized to help you prepare a correct return or to help do a proper reporting of these assets? Is there any guidance out there yet of like how to sit down with a taxpayer at the beginning of the year to say, okay, you're in this space, here's what you need to be thinking about? It's more than just bring me your bank statement, right? This is not the old days of bring me your ledger from the shop, right? So have you all thought about that within these groups that you're in, like how to deal with the people on the ground who are in the space?
Oh, absolutely. I'm part of the crypto CFO community, and we've had a lot of conversations about taxation issues. In particular, like, make sure your clients, the first thing you're going to be asked by a tax accountant is, I need a full list of every wallet you own. Like, do not hold back. Don't hide any wallets from me. Don't think, oh, well, this one isn't important. We need to know all the wallets you have. Because, a lot of these transactions are on public blockchains. So, when we go and look in and try to follow the activity or confirm any activity or balances, I mean, we're going to see who you sent money to and all the other wallets that were sent to. So it's like, just don't try to hide it. If you're doing, I'd say, relatively low volume trading, a tool like Crypto Tax Calculator, I use it. I love it. It's fantastic. You plug in your wallets, and if it's a public blockchain wallet, like an anonymous wallet, it'll pull the data from the blockchain. Or if you have an account on like an exchange, like Coinbase or elsewhere, or Binance, you can put in your login credentials and it'll pull down your activity. And it organizes everything. You do have to go through and kind of identify like what was this transaction, and whether you own a wallet that it was transferred to, because if you're transferring between two wallets you own, there's no tax event happening there, right? But I'd say just keep good records. If you are doing a lot of activity, you're a high activity person, you're making most of your money off of DeFi and trading and staking and other types of liquidity activity, I'd say that keep great records, and also potentially do a reconciliation of your activity and understand what's happening on a more frequent basis, quarterly, maybe even monthly. Understand, like, here's my activity, here's my tax liability. That might mean you involve a tax accountant to periodically work with you and keep up with stuff. Otherwise you get to the end of the year, you've got 20,000 transactions and you can't remember what those transactions were 11 months ago, where you were, doing something in some DeFi pools, right? And there's no record of it outside of some transactions on a blockchain.
I think you mentioned, two words that I think we all preach to our clients, even when you're not in the virtual space. It's great records, right? And so keeping great records, it's easy advice to give. I think it can be hard to implement for some of these taxpayers. I've been around, hypothetically, some folks who are younger. They're really in this space heavily. They don't come into it with a lot of capital themselves, but they've built up some virtual currency. And then before you know it, they're trying to open businesses in the space. And what I have seen is there'll be individuals who are trying to pay people with virtual currency, but they're moving so fast, right? They don't view this as, well, how is this payment treated, right? What's the employment tax due on giving someone virtual currency, right? They think they're moving in a space that is somehow beyond what a normal payment, and they're not. They're still responsible for all the reporting of payment, however they're paying these individuals. But I've seen this more than once, where in particular younger individuals, I'm talking teenagers, people in their early 20s who have not hit it big yet, but they're trying to enter the space. They have a business that has employees or independent contractors who are happy to be paid in certain types of digital assets. Keeping great records of that type of activity for a young person, I think it's incumbent upon us as the more mature professionals to say, well, you're still trying to run a business. Here's what a great record looks like. Here's your checklist.
Yeah,
right?
exactly.
They're in that checklist.
We've developed a checklist in the crypto CFO community. We have, onboarding checklists and client checklists. So I would, recommend that you talk to, get a tax account, pay for it. Sit down with them and say, what do you need from me? Find someone you like who can handle this for you. It is overwhelming if you do not do accounting, if you don't really particularly like taxes. It is overwhelming to figure out it for yourself. So I would say get a professional involved.
That's right. Damon, you were going to say?
Yeah, there is one backstop that we have in this area that you don't have in the fiat currency area, and that is the blockchain. It would be almost impossible. It's not impossible, almost impossible to alter the transactions that are on there.
Right.
Because of the way the blockchain is built and because of the cryptography. And there are forensic firms that specialize in going back into each of your wallets and tracing each of your transactions through whichever blockchain you happen to find yourself on. Probably another area, I know Stacey. So I just wanted to say that because Mike mentioned, there's a businessman that brings you two ledgers to your accountant. In my area for the past 25 years, the businessman would pick which ledger he was going to bring to the accountant because there were two different ones. But on the blockchain, it can't alter it like that. So that's a great backstop for these new forensic firms that do this kind of work to help out and make sure that the reporting is accurate.
I think that's a really interesting point. It's almost ironic, right? Because in the early days of virtual currencies, I think law enforcement often looked at some of these types of digital assets as purely the work of folks who wanted to hide their money, right? Folks who wanted that anonymity, right? Who maybe were involved in criminal activity. But now the ironic part of it is the way the blockchain operates. you can't have the two ledgers. So it's almost now it's a better way to track people to the extent it becomes more in the light as it is now, right?
And based on the research, the nefarious activity on the blockchain is under 2%.
That's amazing.
When we first started looking at it, when I was back in CI, we used to think that it would have 80 to 90% money launderers. That's who would use this kind of activity. Now, you're buying pizza, you're buying coffee, you're having senators talk about, putting some laws and regulations around this. It's totally different.
I think one other really important point that has to be pointed out when it comes down to your records and how you're doing this is like cost basis is a big issue. And my understanding is the IRS, and they call this out in their FAQ and their standards around, or what they've issued around virtual currency, consistency. Like pick a method and then stick to it. You're going to draw more scrutiny if you suddenly change your method or you have a different method for different types of activity or different wallets. You need to pick a method. And when I say pick a method, I mean LIFO, last in, first out, FIFO, first in, first out. FIFO is probably the default for most. HIFO, specific identification. HIFO, specific identification, really difficult to do for high volume people. It's much easier for infrequent people who are just kind of buying a little here and there for the purpose of investment or value appreciation. Pick a method, stick to it, keep your records, you're going to be fine.
I think that's really good advice. If you're also, one of the things we worry about in this space is the eventuality of audits, possibly higher audit rates for an area that is still evolving. And so how do you plan to defend for an audit or an investigation, whether it's a civil or criminal side, right? And when you pick a method and give that uniformity, and when you have those records, it allows folks like me who are on the litigation side and who handle audits of cases like this, it allows us to go combat the IRS easier to say, no, we've picked one method, we've stuck with it, we can trace all these transactions, and it allows us to go back to the source records and combat the IRS when they challenge how we've reported some of these virtual currency transactions. Talking about the government's regulations a little bit and some new guidance that's out there. Damon, can you give us a little bit of an update from the IRS's perspective? I think there's some new chief counsel memos out there as recently as last month of this year.
Sure, certainly. The two latest ones we have are the advisories that came out on 113. They were actually released on 113, and they talked about the qualified appraisal requirements for charitable contributions. So, and so the threshold is if you want to take a deduction over $5,000, this kind of CCA suggests that you have to get a qualified appraisal. So so they asked the issue, if the taxpayer fails to get a qualified appraisal, does a reasonable cause exception apply? Could I now go on to Coinbase and say, I didn't get a qualified appraisal, but can I go to a Coinbase or any other reputable site and say, my Bitcoin is worth $10 a Bitcoin? Can I use that instead? This CCA says, no, you can't do that because of some various reasons, but it won't be deductible under 170A. I was talking about this on a different podcast, and I was saying, well, what if the charitable organization the next day turns your crypto into fiat currency for the very same amount that you gave it in? Do you still get the donation? I think that's up for debate. Do you still need a qualified appraisal? So, I mean, there's some room in there. And so qualified appraisal, the same in all the areas you practice in, Mike. It's you got to have a professional designation in the area, regularly perform appraisals, and then there's other requirements that the secretary might make. The government is kind of tough on qualified appraisals, as you know, but this is one of the recommendations they're making.
For the listeners at home, what Damon's referring to is that there are other areas of the tax code, not just involving virtual currency, where if you're making charitable donations of property, right now there's a number of cases out there in the country related to syndicated conservation easements. We could have a separate week-long series of podcasts on those transactions, but they center on what is that property worth and valued at, and who are the appraisers that are coming up with the values that are related to the deduction that ultimately flows to the donor and or the investors and entities that are making the donation. And so the appraiser and the appraisal process is a very important process in which I's have to be dotted, T's have to be crossed in order to make sure that you're solidifying this potential contribution and the deduction. So that's a related field as to what we're just talking about. Was there another, Chief Counsel?
Yeah, so there was a second one. This one deals with the applicability of Section 165. And is that if your cryptocurrency has a decline in value, in general, Section 165 provides for a deduction of losses sustained during a taxable year. And so, of course, all taxpayers want to take advantage of that. But during this particular market, since cryptocurrency has gone down so much, the question has been arising, can taxpayers take advantage of the 165 in this crypto market? The basic answer is no, but because it hasn't been a terminal event. If you still own the cryptocurrency. And it might go down to 1 cent, but it still has some value. You might not like it. Basically what it says, you might not like the value, but it still has some value. So you don't get to claim the loss in that. And then it doesn't fall under this special provision that under Section 67G, which suspends miscellaneous items from 2018 to 2025. And so this would have been considered a miscellaneous item. Here we are in 2023. It doesn't fit. We're not outside of the box yet.
That's interesting. And I think this is a very, applicable, concept to maybe even talk about our next topic for a couple of minutes anyway, with the FTX collapse, right? And so, here we're talking about, well, when is a virtual currency potentially worthless, right? I mean, that's what this advice is getting at. When can you take this deduction, if at all? And in a market that's so volatile, right? I mean, we've seen what the prices of virtual currencies have done in the last, last couple of months, right? Deeming something worthless could be a potentially big issue for some of these digital assets, right? And now here, if you transition that discussion over to FTX, now you've got over 1 million investors who had virtual currency on this platform who may have lost money. Maybe they have something that's worthless, but according to this, maybe you're not getting a worthless deduction, right?
Probably you might not. And then to add insult to injury, there was right before FTX, there was a Celsius decision. Celsius went into bankruptcy, but because when you punch through that agreement, it says, "Oh, I agree to these terms and conditions." Well, in those terms and conditions, it was so vague that the bankruptcy judge said any interest that was on the Celsius platform is now owned by Celsius. So those people lost it.
Wow.
Yeah, they're enforcing not your keys, not your crypto.
Right.
And
Exactly.
There's been a flight to DeFi and to hardware wallets for anyone who's, dedicated to the space of let's just get off of centralized exchanges. Don't hold a lot of money on a centralized exchange because you stand to lose it.
Precisely.
If that exchange hits problems. Now, some of them are considered more trustworthy than others, but it's definitely got its risks. Put it like that.
That's really interesting. So a flight to hard wallets, because this ruling would say it may be not your interest at all.
That's right.
Right?
Exactly.
And now with FTX, we have a bankruptcy trustee working on a case trying to essentially, figure out what happened in this situation, number one, and then number two, what, if anything, can be recovered for whoever the potential victims may be. Right. And so this trustee process, I think for the listeners at home to understand, one thing to take away from it is it's a long process. No one can access this stuff tomorrow and try to get their virtual currency off of this platform. And so this process that FTX is undergoing right now leaves a lot of investors asking questions about their personal positions and exposure. So we could sit here and have a different podcast on FTX for weeks upon weeks upon weeks, right? There's so many issues involving potential allegations at this point, just allegations. Remember, I'm a criminal defense lawyer, so these are mere allegations. All right, that's what an indictment is. But aside from those allegations, we've actually got that's against the entity and then the executives that worked at that company. But what about all these investors? They're going to call people like you at home that are listening in who are accountants, or they're going to call Stacey or myself and say, can I take a deduction for this? This was stolen from me. He bought that house in the Bahamas with it or whatever, right? Allegedly. But whatever happened here, that people who are holding the bag, what are some of the things or issues they might consider? So Stacey, have you ever taken a look at, can you take losses on this type of activity, like a theft loss, for example? Is there an opportunity for any kind of deduction yet? Any brainstorming on that front?
Yeah, absolutely. This has been a hot topic in the accounting space for the last couple of months of like, how are we supposed to treat this? What are we going to do? You can't take worthless securities deduction because for once, crypto is not securities. SEC has not yet proven their case that they're securities. So you can't do that deduction. A theft loss, you need a guilty verdict or some kind of court, that's what I understand it to be. And so what I'm hearing from other crypto tax accountants is that the FTX situation isn't going to meet the criteria to claim a theft loss. So what you kind of have is you're stuck in a situation with really only two options. You can take a regular capital loss at this point, and then if you get anything from the bankruptcy settlement, it'll be ordinary income. If you take that loss today, this year, then you're going to have to recognize ordinary income if you ever get anything from that settlement payout, and you'll owe tax on that, your ordinary income tax. Kind of sucks because that's, you're getting paid out with what you originally invested was after-tax money, and then you're going to get it back to you, and then you have to pay tax on it again. So
Right.
It sucks, right? It's not great.
No, that's exactly right. And on the theft loss, you've mentioned that one of the problems is you have to have some kind of finality. You can't just unilaterally say, well, I'm missing some money, I'm going to have a theft loss deduction. You actually have to meet certain requirements under the code to claim a theft loss deduction. And there's a timing component to it. And there's also an issue of what other avenues do you have that you potentially still have recourse to get this money back. And so those are all issues.
Most people are saying, look, at this point, just file extensions and keep filing and keep extending for as long as you can, with the hope that something like this happens. Either the IRS provides specific guidance and says, this is how you can handle this. There maybe something develops with the court case against Sam Bankman-Fried and theft loss becomes possible. Or you extend until the settlement payout comes in, and then you kind of figure things out. I mean, obviously it's going to be highly dependent on a person's situation and how much they have invested and what they view as the probability of getting a payout in that settlement. Me personally, I wouldn't take the extension option unless I've got a lot of cash on the line, and I think there's a high probability that I'm going to get something in that settlement, because that's a lot of extending and extending and extending.
Well, look, I think that one of the messages to take away here is that if you've got a client out there who's an investor, if you yourself listening in were an investor who has a question about this, you need to go to a tax professional who's knowledgeable in the space to understand the different options of how do you potentially move forward while you're waiting for this legal process to unfold. We are nearing the end of our time here with our listeners today. Damon, did you want to just touch for 1 minute on any other enforcement initiatives? I mean, one thing that comes to mind is there was John Doe summonses that went out. For listeners that don't know, maybe touch on what is this John Doe summons and how do they get names of people who invest in virtual currency?
Certainly. There have been some very large ones that a lot of people have probably heard about in the news. Circle, Kraken, SBOX. Basically, a John Doe summons for the government is an invaluable tool because it's an ex parte order. The government just goes to judge by themselves. They generally have to prove, initially they had to prove 3 elements, that they were investigating a particular person or an ascertainable class or group, and that class or group failed to comply in some manner against the IRS. Lastly, that there is no other way for them to get the information but this order. The latest, the judges started coming down there lately and said, now, with all those 3 requirements, now it has to be narrowly tailored. So generally, without speaking in any one of those, anyone specifically, the Kraken or Circle or SBOX, they were looking at people who had transacted over $20,000 in cryptocurrency during a certain period of times. And so what they were going to do is match that with filings. There's on the 1040, there's a line that says, do you have cryptocurrency? And so if you check no, and then your name pops up in a John Doe summons, and you have over $20,000 in transactions, then you're going to be tagged. So that's what those are about. And there's a lot of information out there from the IRS. If you look at the 2022 from criminal investigation, their annual report, the chief of CI said he's hiring 500 more agents this year, and he expects hundreds of more cryptocurrency cases. So those will be criminal cryptocurrency cases.
Yeah, I think that's an important message to kind of end on, is that for the listeners at home to understand that if you've got taxpayers that if they're not reporting the virtual currency, if you were listening closely to what Damon just said, there's a line on the 1040 that says, do you own virtual currency? It's not asking if you owe tax on it. It just it's the information reporting. And now the IRS is utilizing tools to catch people who are lying about owning the virtual currency. And then that can become the basis for yet another question, which could lead to, did you have unreported tax on virtual currency? It's a separate question, right? And so these are potential criminal questions in the virtual currency world. I think we're kind of getting to the end of our time here today. I would thank our speakers for joining us. I would remind our listeners that if they have any comments or questions, you are more than welcome to reach out to us, myself, Mike Villa with Meadows Collier, or Stacey Ferris with HKA, or Damon Rowe. Happy to talk to you, and let my friend Eric Green know if you've got questions or comments, or if you'd like some additional podcasts on this topic. Thank you for your time today.
Thank you all.